Good morning, good afternoon, good evening, and welcome to the Tuesday, the 22nd of March, Trade Bull versus Bear TradeDay.com daily webinar. So, welcome everyone. We're going to go through our usual regular run through in here today. We're going to take a look at the calendar, what we've had, what we've got coming up. We will take a look at the articles from the major news wires. What's influencing markets right now from a macroeconomic, geopolitical, fundamental perspective, and then we'll take a look at the charts to see what's going on from a technical analysis perspective. So, calendar first of all, just looking back, we're going to talk a little bit going forward about the Jerome Powell speaking yesterday. But going into today, we've got more central bankers in play. Panetta and Lagarde from the ECB, Williams from the Fed. We've got Bank of England MPC member Cunliffe speaking, the SNB chairman Jordan speaking, ECB chief economist Lane is speaking, FOMC member Daly also speaking, and Mester from the Fed also speaking today. Huge amount of speakers in here, central bank speakers. Obviously, inflationary pressures, stagflation fears, Ukraine, Russia, all of those things in the mix to potentially kind of come through. So there's a lot to be potentially happening today in here. I didn't have much on the data calendar in my previous post, but however, markets did. I don't know whether these have been pushed in more recently, but I didn't see many of these, so I don't know whether they've been added in. But nevertheless, we do have a load of central bank speakers in here today, so do please keep an eye on those as they come throughout the day in here. Kicking off in the next couple of hours with Panetta from the ECB and going through the US morning / European afternoon. So keep an eye on those. If you are trading any of these markets, these could be impactful, right? If they start talking about, maybe concerted efforts regarding Ukraine, Russia, it could be talking about sanctions. It could be talking about any kind of loads of different developments we could have there. So really keeping an eye on that. Just looking backwards in here. And starting on 5 things to start your day. Powell was in the headlines yesterday. 50 basis points is a potential. Okay, so we've been monitoring this on our CME tool, the CME countdown tool in here on the Fed Watch. Now look what we got for May. Now remember, this has been sitting about 50-50. Most of the time, if anything, this column here for a 25 basis point hike. Remember, we're already at current target rate is 25 to 30. So this is now aiming at a 50 to 75. This was, if anything, larger than this column. Okay, so this was saying there's more chance of a 25 basis point and 0.25% rate hike at the 4th meeting in here. You can see it on this tab here, the 4th of May meeting. Now, though, we're pricing in up to a 60% chance of it being actually a 50 basis point interest rate hike. And basically, Powell opened the door to that, completely opened the door to that. A more hawkish tone than we'd seen literally just last week on Wednesday in the statement and press conference after the Federal Reserve meeting when they hiked interest rates for the first time. Quotes in here. Look, jobs essentially shifting from a jobs at any cost policy to a kill inflation at any cost stance. Okay, so so the market's certainly reacting to that, and we'll take a look. Well, I'll look right now. I'll show you a huge move in bonds. So this is the US Treasury bonds. Don't usually start off with this one on the chart, but a huge sell-off in bonds. Remember, this is lower bond prices equals higher bond yields. Pricing in here, higher interest rates, but also pricing in a sell-off in bonds because bonds less attractive in an inflationary environment. Yeah, potential in here for recession as well. So recession negative in here, and so no safe haven bid in here at all coming through from the Ukraine situation in here. Bond prices lower, lower yields, lower prices, higher yields in here, reflecting the fact that we're going to see a more hawkish Fed and fears around inflation and fears around recession. All of these pointing bonds lower. So a massive sell-off in here. And I think I read in here the rates move. Where is it? Biggest move in here for, okay. No, I don't see in here. I did see there was maybe we'll come across the headlines we go through in here, but it was like the biggest move in bonds for so many weeks or months or something like that. So we'll come to that as we go through, hopefully. So we've got that. That was a big event for yesterday. Now, that did spook markets. Equity markets a little lower, but equity markets dipped and rebounded. Equity markets are now pricing in. They want They want the Fed to be on top of this. They want to see inflation under control. So actually a more hawkish Fed, which is previously would have been de facto a more negative for equity markets, is now playing into a more positive for equity markets. So equity markets in here dipped and rebounded. Okay, they're liking the fact that the Fed are trying to take control of this. They're liking the fact that the Fed are acknowledging the inflation pressures. They like the fact that even though higher interest rates are negative for the consumer, they're negative for corporates, which is usually a negative then for stocks. They're actually seeing this as a kind of the better the devil you know almost. This is what needs to be done to keep inflation under control so we don't go down a route of stagflation. Remember, stagflation equals high inflation and also a slowdown in growth and potentially recession. Okay, so we don't want to see that. Okay, stock indices don't want to see that. So hence the more hawkish tone, if anything, that we saw coming through from Jerome Powell yesterday or Monday certainly was the net result was stocks dipped and then rebounded and actually ended up relatively positive on the day. And we'll come to take a look at that as we go forward. So let's just finish off going through the rest in here. So foreign holders of sovereign bonds in Neutrality are watching their accounts of the guns said a $66 million payout had been made to its local depository. So Russian is paying its debt in dollars by the looks of it. So that's seen as a positive. Where was the other thing? I'm not going to bother with this in here. Stocks higher this morning. The banking and insurance sectors higher in Europe. Okay, potentially, higher interest rates across the board potentially are positive for the financial sector. So European financial markets helping the European stocks higher after a somewhat subdued move that we saw yesterday. Bond markets continue a retreat. So European bond markets continue lower as we see the futures market pointing lower in here. Data-wise, we've not got much in the mix. Let's just run through some of these headlines that are pulled up for us today. So stock futures gain and origin. The other thing is oil's dipped back lower. So oil's had a really strong rebound in here. End of last week, beginning of this week, through yesterday. Oil retreated slightly, so oil lower is obviously still we're seeing that we did mention yesterday the inverse relationship that we've seen more recently between oil. Higher oil was negative for stocks, right? Higher oil inflationary pressures that when it spiked up to $130, it's very negative for stocks. And on the retreat back lower, stocks rebounded. However, stocks have continued their push higher with oil rebounding from the end of last week through the beginning of this week. However, there is still a correlation. If oil goes back lower, that's not going to be negative for stocks. That should be positive for stocks. So oil's dipped back lower in here. That's helped markets back higher in here. So look, bonds extend their sell-off. European bonds even lower today. The future US bond futures lower today. Financials will lead the gain in the European sector in here. Okay, let's move on. Powell is ready to half-point hike. We've already covered that. Fed share says curbing inflation is top priority for 2022. And also flags risk of war pushing inflation expectations too high. So we've already covered that. Bonds in here. What do we got? Also from Bloomberg. If and when it loads, here we are. Bonds extend dropped after Fed sparks one of worst days in decades. Okay, so this is the headline I was talking about. Why did it part of the yield curve narrows to at least since 2007? Potential half-point rate hike casts fresh uncertainty. So this is what we're talking about in here with the bond market sell-off. Bond extension drop after Fed sparks one of worst days. So let's actually see in here. Where did I see this? Okay, so here we go. Two rose 5 basis on to 217 on Tuesday. So this morning, 2-year notes up another 5 basis points, having been up 18 basis points. And the gap between 5s and 30s, so that's the yield curve, narrowed further to the smallest since 2007, okay, indicating expectations of tighter policy with slowly rising in core recession. So I think we spoke about this last week, an inverted yield curve, okay? Usually it's done on the 2s, 10s part of the curve, between the 2-year yield and the 10-year curve. If that inverts, historically, that has been a very strong signal that a recession will follow in the next 1 to 2 years. Now, it did invert. We had a slight inversion. It was only very briefly. We did get an inverted yield curve back through the pandemic, and we didn't get a subsequent recession, okay? So it's not always the case, but we're getting a very narrow gap in that moment between the 5s, 30s part of the curve, the narrowest since 2007, and that, remember, was pre-2007, just pre the global financial crisis, and that certainly caused a recession. Okay, yeah, we've got real concerns that the recessionary pressures in here potentially being signaled by the market because of the flattening of the yield curve, and if that goes inverted, that will be a real concern in here. Okay, so yeah, it's something to keep an eye on going forward. The 2s, 10s, and the 5s, 30s segments of the yield curves. Rates markets losing faith in Fed's soft landing scenario. So look, Eurodoll's pricing interest rate cuts after June 23. So now we're looking at the fact that post June 23, the market in here, Eurodollar. So if we actually go and look at it in here, what we see post June 2023, if I can look at it here. So you can see in here, this is starting to fall here. And what it's actually saying is it's hitting a peak. And then what we're expecting is then potential going beyond June 2023 is that interest rates actually start falling. Okay, interest rates actually start falling if we go take a look out into June 2023. And why would they be falling? Well, because we would be hitting recession at that point. So the market's losing faith in Fed soft landing. A soft landing is when we get a slowdown in growth, but it doesn't go to recession. Okay, that's a soft landing. We are expecting a slowdown in growth because obviously we were hiking in. What's the feed in there? Let me see if I can re-share that. Do you have the feed in there, guys? I don't see it in my stream in here. 1 second. Let me see if I can reconnect that stream in here. Just bear with me 1 second. One second, guys. There we go. Okay, it's reconnected the stream. Okay, so yeah, so rates market's losing faith in Fed soft landing. As I say, in there, soft landing is when we get a slowdown in growth, but we don't get growth going to negative. We don't get a recession kick in. Okay, so it's something to we're going to be keeping an eye on. Certainly, keeping an eye on that further out. And look, yield curve crushed following Powell's talks of inflation risk. So again, yield curve flattening there. Let's run through some of the what we're seeing on Reuters. So those are Bloomberg articles. So here we're just showing, I'm just going to show you European bourses. The European averages are all up in here, not hugely up, between half, just between, well, 1/4 and 1% in here, between 0.25 and 1.0% for most of the major stock indices in Europe. CAC, the French index up 0.63, DAX up 0.83. Look at the FTSE up 0.55. So European bourses, European stock indices, cash indices up higher. Yesterday we actually did see S&P actually finished flat. Dow Jones, we spoke about Dow yesterday. Dow Jones actually down on the day due to the fact that we had Boeing, the negativity from Boeing because of the plane crash in the 737 plane crash in China in here, putting doubts over Boeing again. And remember, Boeing makes up a large part of the Dow because it is a price-weighted index, whereas the S&P is a capital-weighted index. But if we look in here today, what do we see? We see all of the major averages not massively up, but nevertheless up between 1/4 and 0.5% in here this morning, rebounding higher. So those are the futures markets pointing to a higher open. European stocks edge higher, yields rise as market adjusts rates expectations. We've already kind of covered that. Fed will raise rates more aggressive if needed. Powell says we've already kind of covered that. And then also reiterating on oil. Oil sits below $140 as EU split over Russian ban in here. One other thing I wanted to note in here from Forex Live. Where is it? Okay. Okay, Monday, Moscow says Russia-Ukraine talks are still continuing. So we've heard this continuously out of the Kremlin, okay? Not anything that's positive, but the fact that they are still talking, hopefully, is seen as a positive, okay? So that, no doubt, helping, assisting the equity asset classes higher. So bonds. We looked at the bond market, downside pressures on bonds in here still. Let's take a look at the stock indices. I'm going to kick off with the S&P 500. So we spoke about it yesterday with the market already dipped and rebounded yesterday and then pushed higher, nudged higher. We're not quite above this peak in here. See this swing high in here. That swing high there from back on the, my birthday, 16th of February. That high there was 44.76.5, okay? And we've been up to 44.73 yesterday and today 72 and up. And again, look, dip and a rebound yesterday. I think remember we had a multi-day, 4-day surge, a massive rally last week in here, Tuesday through Friday, massive rally Tuesday through Friday, from almost posting a new multi-month low in here, the market surging back higher in here, getting back. Remember we spoke about this, but that's the whole sell-off. Okay, we've got back over 50%. Effectively, that rally there is over 50% of the whole sell-off in 4 days, and then the market's kind of consolidated those gains with what I would call here a high level consolidation. So the market's you get a dip and it's rebounded. Again, overnight, a dip and a rebound. So it's a very positive consolidation, a high level consolidation, and that usually indicates potential for an extension higher. And we'll come to look at that on the 30-minute chart. But that next peak there,